Afternoon or good morning if you are out west. Welcome to the Equifax Canada Business Credit Trends webinar. I'm Sinead Gleason, Business Solutions Product Lead, and I will be taking you through today's webinar where we will look back at the first quarter of 2023. Summer's officially only a few weeks away, but recently it's kind of felt like peak summer, especially in the Toronto area. And the wildfire situation that seems to be clear across the entire country is getting pretty serious. In fact, you can actually even see the smoke all the way down here in Toronto today. But I hope that wherever you are joining us from, that you are safe and breathing in clean air. For the next hour, we will look back at the end of the winter season and examine how things turned out for Canadian businesses. Anyways, before we do dive in, I will pass things over to my colleague Mehtab, who will walk us through a few housekeeping items. Mehtab?
Thank you, Sinead, and hello, everyone. Each area within the On24 webinar platform is responsive, so you can maximize or minimize each widget or box on your screen based on your viewing needs. There is an Ask a Question widget underneath the slide area, so feel free to enter any questions you may have, and we'll address them throughout our session today. In the event there are too many questions to get through, we will generate a FAQ document which we'll send out to you in the coming weeks. Some related content is available for download in the related content area, along with today's presentation in English and French. This session is being recorded and you'll receive the on-demand link via email tomorrow. Some additional features you'll notice at the bottom of your screen are reactions, our survey, which will pop up at the end of the webinar, and contact us. So feel free to check any of these out and provide your feedback. Now let's get started. Sinead, back to you.
Thank you, Mehtab. Okay, so let's think back to the first quarter. Inflation continued to rise. The news cycles wondered if we were headed into a recession, and we saw the last of the ongoing rate hikes in January, up to 4.5%, which held for the entirety of the quarter. Retail sales were down, but services and travel industry numbers were up. Overall, the economy showed some unexpected improvement and GDP beat expectations. So what we're going to look at right now is some of that key indicator data. So on the left-hand side of your screen, you're looking at the labor force, employment and unemployment rates. The employment numbers softened a little bit in the first quarter, and the unemployment rate leveled off, lower than actually prior to the pandemic. And we began to see the job vacancy rate dip at the end of 2022, bucking the upwards trend that that had been consistent throughout the start of 2021. Labor costs, however, continued to rise. And if we go to the next slide, the GDP growth is what we're looking at in those red bars there. And, growth in the first quarter was higher than had been expected. And as I mentioned, the Bank of Canada did hold its policy rate steady at 4.5%. The consumer price index softened, easing inflationary pressures. But as we saw yesterday, the policy rate has now bumped up to 4.75%, which is possibly not the last hike we can expect this year, but I guess we will see. And according to this survey by Statistics Canada, in Q1, Canadian businesses remained optimistic about the outlook for the next 12 months in the first quarter. Okay, so let's take a look at our first quarter business trends from the Equifax data. In Q1, the debt levels that small businesses carried grew to 39,000 on average, which was an increase of 1.7% versus the fourth quarter, but actually 10% higher than the same period last year. Insolvencies continued to show steady growth, but on a year-over-year and both on a year-over-year and a quarter-over-quarter basis. The delinquency rate slowed this quarter, but is up 5% versus the same time last year. And in terms of credit-seeking behavior, we saw that inquiries grew nearly 10% this quarter. So it does appear as though businesses are starting to show some signs of stress in the first quarter of 2023, and we'll dig into that a little bit more deeply. Okay, on this slide, what we're looking at are inquiries. And we're indexing that to where things were before the pandemic. So indexing back to January of 2019. Inquiries, again, are the indicator of credit-seeking activity or credit demand, in other words. The chart begins in Q1 2019, and what you're seeing is that growth of inquiries happens during 2019. And then as the lockdowns begin, credit demand drops significantly and remains low during 21 and 2022. But in Q1 of 2023, the trend is now starting to tick back upwards again, with Ontario and Quebec surpassing the levels that we saw in 2019, in fact. Montreal was the only major city in Canada where we saw credit demand among new businesses grow compared to 2019. Inquiries among new businesses in Montreal grew at 4.3%. And while Alberta as a whole is still below the 2019 levels, mature businesses in Edmonton sought out 1.5% more credit than before in 2019. We did see high-risk segments seeking credit more so than low risk in 2020, when the cost of borrowing was much lower, but due to the recent rate hikes, the high-risk segment is likely to start to trail behind. Okay, so now let's look at credit supply. So first we'll examine credit supply amongst industrial trades, or those are the supplier credit obligations. This is the amount of new credit that has been reported by the industrial trade segment or the non-financial. And given how strong the credit supply was in 2021 as compared to January 2019, we did see an overall decline of new trades in 2022 to the tune of 6.9%. But quarter over quarter, we actually do see a positive growth trajectory in new industrial trades, with the fourth quarter netting out higher than in 2021. And like we saw last quarter, the share of those trades continues to grow amongst the medium to higher risk segments, suggesting that suppliers are willing to tolerate a higher degree of risk. Okay, and now let's take a look at the financial trades. And also, like we saw last quarter, the picture is quite a bit different looking at new financial trades. Again, these are the products that are taken out by the banking sector, so like loans, lines of credit, and cards, indexed back to January of 2019. Compared to the industrial sector, banking trades saw much stronger growth within 2022. But once again, the fourth quarter saw that growth tempered as the trend slows down, as it tends to do each year. But also in contrast to the supplier side, we see the share of those new trades continues to be among the lower risk segments, which account for over 65% of the new trades opened, suggesting that for financial institutions, they're taking a more cautious approach to lending for small businesses. Okay, so looking regionally, we compare we have the financial trades on the left-hand side and the industrial trades on the right-hand side. New banking trades edged down across all major cities. And on the supplier side, the only major city to show growth of new trades was Toronto. All others, they edged down as well, like we saw on the FI side. Okay, so what we wanted to do was dig into the financial trades a little bit deeper this quarter. We want to look at what was happening within the various credit products. So we looked at total outstanding balances across loans, credit cards, and lines of credit. And you'll notice that loan balances declined in the latest quarter by roughly 2.5%, but then grew within credit cards and lines of credit by 15% and 11% respectively. The decline of loan balances is notable, given that compared to 2020, installment loan balances grew by more than 35%. Pardon me. Balances have shifted now over to more flexible products with rates that can vary and more flexible payments. And so that suggests a couple of things. So firstly, Fewer new startup businesses would require fewer new installment loans to get those businesses up and running. And as we see a slowdown of new openings, this will have an impact on installment loan balances. But secondly, of existing businesses, they might be more inclined to leverage credit products that provide more flexibility with repayments, as well as also with interest rates, should those begin to come down again. So instead of looking for locking in for a fixed period at a potentially higher rate, businesses may be hedging their bets and kind of, deferring those payments down the road a little bit. Regionally, we saw that lines of credit in BC reported the largest annual increase in outstanding balances at almost 14%. And for installment loans, Alberta saw the most pronounced drop in balances of 5.1%. Okay, let's look at business openings now. When you look at this slide, it's kind of hard not to focus on those growth periods that we typically see in those summer months. But the Q1 period does tend to be quite moderate in terms of business openings. January, February, March for the last 2 years has shown a month-over-month growth trajectory. So in 2021 and 2022, we saw early positive momentum as the economy opened back up. This year, though, we see that the trend that would be typical prior to the pandemic, things are kind of returning back to where things used to be. And we see a bit of a dip at the start of the year in terms of new business openings. And while business starts are lower than we've seen in the last couple of years, they are in fact slightly higher this year than they were in 2019. So it will be interesting to watch what happens in those peak months that are still yet to come. Okay, let's take a look now at business activity. So when we examine the level of credit activity over the last couple of years, what we've seen is a rush of activity as soon as the lockdowns ended. And what the numbers on this slide represent are the proportion of businesses in the Equifax database which are reporting trade activity within the last 6 months. And so that represents what we call credit active businesses. We're seeing that activity settle down in recent quarters. And regionally, most provinces are reporting declines in credit activity of about 1% to 2%, while Alberta shows a decline of nearly 2.5%. Okay, now let's take a look at delinquency rates. So the graph on the left are the delinquencies within financial trades. And on the right, those are the industrial trades or the supplier side. The blue line is the early stage delinquencies, orange is the 60 plus, and gray are the late stage delinquencies. And we see an increase for the last several quarters for both industrial and financial trade delinquencies. It's quite a bit more pronounced on the financial side, particularly the early delinquency rates. Businesses wanting to pay their suppliers first would appear to potentially be doing so at the expense of their financial obligations. However, there have also been 3 consecutive quarters now of a rise in delinquencies on the supplier side too. Something for lenders, both supplier and FIs, to be aware of as we head into another period of rate hikes. Okay, and then let's take a look at the roll rate. So roll rates, this is defined as the percent of accounts that move from 30 to 60 or 60 to 90 days delinquent. And looking at the roll rates kind of confirms what we were seeing, the supplier repayments taking priority over those financial trades, as the movement from early to late delinquencies is sharply on the rise within the FI trades, but actually dropping on the supplier side. And let's take a look now at delinquencies by industry. Okay, so looking at where those delinquencies are coming from, on a quarter-over-quarter basis, the construction industry is actually doing pretty good, reporting declines on both a quarter-over-quarter and a year-over-year basis. Manufacturing and transportation are both reporting decreases in delinquencies this quarter. Retail trade and services were both fairly flat, but the finance, insurance, real estate segment, which contains property holding and property management companies, are seeing an increase in both quarter over quarter and a year over year basis. Okay, and then lastly, let's take a look at bankruptcies. And we have been watching a slow and steady increase in bankruptcies, and in that first quarter, we definitely see that quite a peak. The April data is out now, and we see that starting to come back down, but there was a much higher number of bankruptcies in the first quarter than we've seen in quite a while. And that the same is also true for proposals. And again, that's sort of more signs of continued financial strain amongst Canadian businesses. And with that, let's recap the highlights from the first quarter. So key takeaways: Canadian businesses are taking on more debt, with balances growing to $39,000 on average, as well as the demand for credit is continuing to rise. New business starts edged down in the first quarter, but they maintained that moderate pace that we've seen since early 2021. The growth that we saw in financial trades saw a shift in balances as businesses appear to both react to rate hikes by leveraging products with flexible rates and flexible repayments, but also displayed less demand for fixed-term loans. We saw growing signals of financial stress as delinquencies are on the rise back to pre-pandemic levels, and late-stage delinquencies have been steadily rising, particularly within Western Canada. Construction, manufacturing, and transportation industries reported a decline in delinquency rates quarter over quarter, while year over year, most sectors report increases. And finally, business activity levels were stabilizing amongst credit-active businesses, returning to pre-pandemic levels. And with that, that brings us to our panel discussion. And joining me today are two wonderful guest speakers. We have the pleasure of Michael Roth, President and CEO of the CFLA, as well as our very own Equifax's Jeff Brown, Head of Commercial Solutions. Gentlemen, thank you both for joining me today. Michael, would you mind introducing yourself and give us a bit of a background on the Canadian Finance and Leasing Association and the great work that you all do there?
Thank you, Sinead. Appreciate the kind introduction, and we always value our partnership with Equifax, which is a key partner of ours here at CFLA. My name's Michael Rota. I am the President and CEO of the Canadian Finance and Leasing Association. I should start out at the outset of saying I'm not an economist or a banker. I'm a lawyer by training, so just keep that in mind as we sort of go through the panel discussion later on. The Canadian Finance and Leasing Association represents the interests of the equipment, auto, finance and leasing industry, as well as fleet. It represents about 200 a little over 200 members, principally made up of most of the large banks, a number of credit unions, the OEM credit facilities and independent leasing companies, and then a number of associate members such as Equifax. But 2/3 of those, I don't think anyone would be surprised to know, are based in Ontario. The industry itself is approximately $439 billion in assets financed as of our last survey. That's up by about 3.4% the year previously, so that's a good news story. And we estimate it represents about 2.2% of GDP and directly employs about 50,000 individuals, about 350 indirectly, which would translate to about 1.9% of national employment. The mission of the CFLA is to support, inform, and advocate on behalf of our members. The key part of that is our federal and provincial advocacy, ensuring that our members have a seat at the table when there's any policy changes. And again, we'll talk a little bit more about that later on. On the intelligence side, we do have a lot of key industry and association credit trends and material for our members, one of which is the quarterly Equifax credit trends. We do the Canadian market overview. We do an equipment finance activity survey, fleet residuals, and business confidence surveys, and a number of others. And then finally, in terms of sort of the supporting, we have a lot of networking events. One which Equifax will be participating in September, which is our national annual conference in Quebec City, which is always a fun time. So that's a little bit about the association, and happy to answer any questions you have, Sinead.
That's great, thank you. And Jeff, would you mind introducing yourself? Because there may have been a couple of quarters now where perhaps there's new folks who haven't met you before. Jeff used to host these prior to myself. So Jeff, would you mind taking a minute to introduce yourself and the work that you do here at Equifax?
Yeah, no problem. So I'm Jeff Brown. I'm the head of our commercial line of business here at Equifax Canada. And like Sinead mentioned, you've likely seen or heard me at credit industry events, covering trends, small business, as well as general advocate for small businesses. So I'm lucky enough to be supported by a team of people that cover strategy, migrating our business to the cloud, or really advising suppliers and lenders of the overall economy. But really happy to be here today.
That's great. It's great to have you both. Thank you both for those introductions. I think before we get to the first question from Michael, what we wanted to do, if the audience would indulge us, we're going to put up a polling question. These are the same questions we actually did last quarter, and we're just kind of interested to get a bit of a pulse check to see how folks are feeling this quarter as compared to last quarter. And I think those results will be made available perhaps afterwards. So our first polling question is, to what extent do you agree with the statement that we are experiencing a market downturn in the industry that you are in the industries that you support? Do you strongly agree, not so sure? I think with the rate hike announcement yesterday, and I don't know, every time I watch the news, I feel like I get mixed messages. So I'm curious to see what our audience has to say. And see if we have sufficient responses. They're coming in. Agree. Yep. But not strongly agree. Okay, that's interesting. Okay, well, let's take our first question to Michael. On that front, Michael, we had expected an economic downturn to be impacting the Canadian economy. What is the CFLA hearing from its members on that front?
Thanks, Sinead. Overall, it's a positive message. Our industry, I think, like the economy more broadly, is a little engine that could. It just seems to keep going. Originations, while not off the charts, still remain positive and are doing well. We do, as I said earlier, a business confidence survey, and we do this twice a year. So we started the year with our survey, and industry confidence was slightly up. We were seeing some concerns around bad debt, but definitely we're doing better than we have been in past years. Looking out a little bit, we do see some delinquencies. In fact, the Equifax data that we get is showing a slight bump in delinquencies for about 3 to 4 months in a row now. But again, overall, I have to stress that originations seem to be positive and holding on. There are some headwinds, though. Interest rates have doubled in a year. Actual costs have doubled as well. We are seeing a spread compression, and likely it's not unusual. You'll see that sort of as things slide down. The opportunity for the spreads to increase will be on sort of the upside, which eventually we will come to see as well. More specifically to the industry, we feel that portfolio management will become key. Risk tolerance practices, for example. So while in the short term, the industry is expecting that it will face some challenges, in the longer term, we do think there is some upside. Now, what that short term looks like, again, not an economist or a banker, so I can't predict. But the asset-based finance industry is a mature industry, and we feel that it is uniquely positioned to accelerate the transition to a low and zero carbon economy. So there is some upside opportunity as the government and the industry itself begin to collaborate and look to incentives that will speed the transition to that new economy.
Awesome, thank you. And Jeff, what about yourself? What, are you hearing, what are you hearing in the industry about concerns over an economic downturn?
Well, really, as you kind of showed in the slides earlier, we're seeing a heightened level of inquiries across both lenders and suppliers right now. So in normal circumstances, these inquiries would be tied to things like new business growth, expansion. However, right now we're seeing a bit of a checking in process with lenders and suppliers alike, kind of evaluating their higher risks, especially around their pillar customer base. Like Michael alluded to, I mean, high interest rates, higher inflation, this checking in process is part of the whole, are we moving towards a recession? Is there more tightening that needs to happen? This is typically the signs you see before something happens, but again, it could kind of go either way. A bit hazy, kind of like the weather. But I would say, based on these pulse check-ins, the tightening and relaxing really happens by kind of province, by industry, and the ebbs and flows of credit health. Fintechs, equipment and leasing companies who weren't necessarily part of the disbursement of pandemic loans seem to really have an edge on this front right now in understanding where their customers are. And it's simply due to the fact that they were forced to learn a bit more about their customer base in kind of a painstaking detail, as the portfolios didn't get the same level of cushion from federal government as traditional lenders and suppliers did. From a small business perspective, really in Canada, on the small business front, we're looking in around the CEBA loans, the Canadian Emergency Business Accounts, and its due dates that are coming up. So that due date's coming up at the end of the year here at end of December. Those $49 billion worth of loans that were taken on by about 900,000 businesses across Canada, they start coming due. And really what that means is a 5% increase per annum into January. So the federal government released some stats back in April saying that only 13% of those total loans have been repaid. So that kind of kicking the can down the road a little bit is sort of happening with small businesses. So if things start to get tighter and these loans still aren't being paid off, small businesses could find themselves in a very difficult situation. So something we're keeping a close eye on, and I know the federal government did as well.
Yeah, definitely. It is concerning, especially when we were seeing before some of the shifting in those balances away from installment loans. It's just something to keep our eye on, definitely. Okay, and then sometimes when we see what's happening in the US, we view it as a bit of a leading indicator here in Canada. Michael, what are your US counterparts observing? Can you speak about that a little?
Sure. It's a very similar story. Maybe even, Canada's doing a little bit better in some ways. Speaking with my colleagues south of the border, I am hearing that in April there was a little softness in the new business volume, which has remained relatively good here in Canada. So they're a little bit ahead of that. There is some confidence, sort of lack of confidence, becoming a bit shaky in the short-term future of the industry, concerns of a looming recession. However, it's not all doom and gloom there. The labor markets are still strong. I think confidence is slightly buoyed by the debt ceiling crisis issue having been resolved. And it's somewhat of a tale of two cities in that some industries are doing better. So construction, IT, and software are a little bit weaker, which is interesting. We'll talk about the Canadian reality a little bit later in the webinar. Industrial and manufacturing seems to be stable, and transportation sort of so somewhere in the middle. So there's some similarities to Canada, but we seem to be a little bit ahead of the curve in terms of sort of the robustness of our economy currently.
Oh, that's great. And Jeff, how about Equifax US? Any sense of what we're observing there?
Yeah, I mean, the US is definitely a different beast than us for sure. I think anytime we're looking at solutions out in the market, we're always looked as kind of like the 10x to US is how we do the measure. But in the US, they're remaining kind of cautiously optimistic, which is great to hear for us because we have the downstream effect of what happens there. But I mean, that being said, there's definitely challenges ahead for them, mainly weighing in on kind of slowdown of GDP, and there's an expectation that employment progress is really going to stall out. So they've seen really good progress here over the course of the year, but the employment is going to be a bit tighter here towards the end of the year is what they're forecasting. Right now, non-federally held consumer and commercial credit has really seen a sharp tightening on terms. Like I said, like we're checking in here in Canada, the U.S. is kind of tightening in on terms. This is likely reflective of some of the situations that have happened with banks in the U.S. here recently as well. And we've seen this is coming out of really Moody's senior loan officer survey. So it's expected this tightening of terms is going to kind of happen throughout the rest of 2023. And it's the way the U.S. is kind of responding is when you hear that maybe pending recession, they've already put some of the gates and measures in place. And the situations that happens with the banks are really just making sure that things are tighter up front. What I will say is in terms of tightening, that's happening a bit stronger with the larger banks compared to the smaller ones, which is actually kind of a good thing as well. Smaller banks typically operate in specific geographies and service specific industries for small businesses as well. So it allows them to be a bit more open with terms and really supporting their local economies rather than just being a blanket slate on the entire U.S. economy. So I think it's a really interesting situation. So the fact that we're not seeing huge alarms go off in the U.S. right now, especially around the small business front, bodes really well for us. So even though there's a bit of haziness that we're seeing from delinquency rates here in Canada on the small business front, our U.S. counterparts are seeing a tightening, but not breaking. So it's good to hear and good to see.
That's great. Okay, why don't we put up our second polling question for our audience? Okay, to what extent, audience, do you agree with this statement that the economic downturn is impacting our clients' businesses? Do you strongly agree? Do you agree? Or are you unsure? And again, these are the same ones if you joined us last quarter that you would have answered back then. And we're interested to see how these answers shift and change with this quarter. How we doing? With the responses coming in? I feel like I should play the Jeopardy soundtrack every time. Just to fill the void, All right. So again, you guys are like, you're not very passionate. You just agree that the economic downturn is impacting our clients' businesses. Okay, why don't we put the third and final polling question up? We won't interrupt the flow of the discussion too much. We'll do that right now while you're all in a question and answer mode. So, to what extent do you agree with this statement that our business is confident that there are opportunities for growth in the current economy? A, strongly agree, and please don't just say that you strongly agree because I said you weren't passionate, or do you agree, or are you unsure? So to what extent do you agree with the statement, our business is confident that there are opportunities for growth in the current economy? And we'll get your honest answers and see how that nets out. Now I feel like I've influenced everybody. That's terrible. I apologize. Hopefully I haven't. Let's see. Let's find out. Oh, agree still. Okay, good. All right, awesome. Thank you for indulging. And let's move on to the next question we have. Okay, so Michael, are there any industries in your observations that seem to be bucking the trend or particularly thriving in this environment?
Yeah, so certainly we do see some strength in the construction and the agricultural sectors, which remain doing well. Construction equipment's in high demand as infrastructure spending remains strong. We saw in the recent federal budget there's potential for further fuel construction equipment demand as capital is directed to accelerating the building again of climate-friendly infrastructure. Also, our agricultural products remain in high demand around the world, possibly boosted somewhat by the unfortunate events going on in the Ukraine. We'll also, unsurprisingly, seeing some promising growth in the healthcare sector. There's a lot of demand in the medical sector, particularly with big push in Ontario for private clinics. So we'll watch and see what happens as participants are waiting to apply for licenses. It's helped somewhat by a shortage of product that continues to be an issue across many sectors, bolstering demand in used vehicles and equipment. Though we do see some alleviation in the automotive side. For example, we saw, I think it was somewhere in the round of 15.4 million vehicles produced this year, as opposed to, I think it was 12.9 million in 2021. So last year we saw an uptick in manufacturing, though inventory levels do remain tight. The consumer demand seems to be softening somewhat. And I recently was on a call with a number of other auto associations and was hearing that particularly in and around so the high-end EV vehicles, there seems to be sort of a little bit of a buildup on the manufacturers' lots. One area that's maybe not quite as robust is long-term or long-haul trucking. We are seeing some higher delinquencies there. I mean, fuel prices have softened, but the freight and transportation costs are still creeping up there and sort of sneaking, cutting a little bit into their profit margins. So that's an area to watch, which interestingly is a little bit different than what we were hearing from our counterparts south of the border.
Well, that's really interesting. And that's interesting what you're saying about the healthcare sector too. I wouldn't have thought of that, but it makes complete sense. Okay, how about Jeff? We saw similar trends this quarter in respect to some of those industries and sectors. What are your thoughts about some of those industries?
Yeah, I definitely have to echo what Michael was saying around the construction front as well. I mean, construction really boomed during the pandemic, even though things like the cost of lumber tripled, and it really grew due to real estate. Now we're seeing a few different trends come out of this as well. So we're seeing continued growth in the construction industry, but just not to the same extent. I mean, there's a lot of organizations that basically came out and said they had the best year on the construction side that they had in 30 or 40 years. Unprecedented. I'm not a fan of that word. Was a term that was really being used a lot. What we are seeing is a bit of a pivot in the construction industry as well. And it's kind of like what we saw through the pandemic, is that businesses just find a way to be able to continue to evolve or find opportunities. One thing that's really happening is around commercial real estate. So cities like Calgary, for example, are seeing high growth thanks to unusually poor commercial real estate. So over the past 12 months, Calgary, for example, has approved a significant number of conversions from office space into living space. So while it's not like true startup development, it is really supporting their labor market, as well as reusing space that obviously wasn't occupied as well. So we are seeing pockets of this really kind of grow out. If that becomes a bit of a trend and that return from office trend starts to kind of lose any momentum, look for that to really open up in other cities as well. But really Calgary is seeing kind of at the forefront of this right now. And whenever we talk about Alberta, it seems to always be a have-not province with delinquencies, challenges in and around the oil and gas market, mining, but really in terms of that change of real estate on the land, it could be something that ends up being a bit of a trend as well. So we've got our eyes closed on some of the reports that come out, specifically around JLL, who does this by province and by city. So an area to really focus in on. So it is spurring a lot of growth. I will say on the equipment leasing finance side, ticket sizes have seen marginal increases as well over the past year, with, again, cost of lending, the cost of machinery as well. But really what we've seen from our customers is that they're also being very aggressive on the recovery efforts as well. Because as your assets, your ticket sizes increase, so does your exposure if you are to lose them. So if there is a continued tightening from banks, really we're going to see that on the equipment leasing and finance side as well, is that you're not going to let bad accounts roll. So the chart that Shane was showing, the 30 to 60 and the 60 to 90, how those rates had gone up almost 15-20%, both in the finance and the supplier side. Really, the industry is really trying to be on top of it to make sure that doesn't grow any further. So, if you're not in those spaces, really take a look at your recovery efforts as well, because if we start to do those check-ins and we notice that accounts in our overall portfolios are slipping a bit, that's one thing that we can do to counteract, is make sure that any recovery efforts for products or services that your organizations do have out are on top of it. I will say, in terms of industries, there was a bit of a rebound with retail, and this was just immediately following the pandemic, right? As everything opened up, we saw everybody going back to restaurants, being able to kind of do the things that they want to be able to do when the restrictions were in place. So with the impact on interest rates and inflation, people can't spend as much. So it's not to where it was pre-pandemic, but that desire, the need is still there. So it is rebounding, just not to the same levels. A positive note on this as well is with the federal government and their commitments around immigration. Immigration took obviously a bit of a hit during the pandemic. And on the employment side, really, that's what a lot of small businesses are looking at right now. Still a lot of open jobs, open employment across the country, but being able to bring in immigration to help support that part of our economy does really bode well for small business moving forward. Obviously, with that as well, it puts pressure on the housing market. So this kind of balance between construction, real estate, and our immigration commitments is going to be an interesting thing to keep an eye on, and to see how our overall economy adjusts as we expand.
Yeah, I would definitely agree on that front for sure. And talking about that, like changing environments, like what we're seeing in Canada, they often lead to changing policies. So Michael, what's the CFLA tracking on that front in terms of policies?
Yeah, so I'll split that between sort of some of our advocacy work and then some of the changes we're seeing within the industry. So interestingly, prior to the pandemic, we were looking at three areas, policy areas for our advocacy push. One was the digital infrastructure for the financial industry. The second was capital investment more broadly in Canada. And the third, illegal exports of stolen vehicles. At the outset of the pandemic, obviously, the emphasis shifted to more pressing matters. But as we sort of came out through the tail end of the pandemic and now a little further on, we're finding these three advocacy priorities to sort of come to the fore again. With the technology side, one of our members made a comment and said, COVID did not create the need for automation, it demanded it. And absolutely that is true. About halfway through the pandemic, we found a very ready ear at both the federal and provincial levels for modernization of the digital infrastructure. A lot of the financial systems were either based on inadequate legacy platforms or were frankly paper-based. So we are continuing to push, for example, for personal property and security registry modernization. And has some successful momentum both in Ontario and in Alberta. And we'll continue to push on that until we have a formal announcement. Another area is e-chattel paper. So instead of using the control of the paper chattel when securitizing the product, we're finding now that there is an appetite again in the provincial governments to move towards an e-chattel paper model. Most recently with an announcement in Alberta, but we've also had that in other provinces, most notably Ontario. The second is capital investment. So we have been working on this in conjunction with the CD Howe for a number of years now. Well, the numbers I gave for the industry at the outset of the conversations for $439 billion in assets financed is an impressive number when we compare ourselves to the rest of the OECD or to our southern counterparts. For every dollar the US spends investing in worker efficiency and business competitiveness, Canadians are only investing about 47 cents. So there's not a silver bullet that will fix that, but tax incentives, the modernization of the systems are things that we think that could drive that. In fact, after this call, I'll be sitting down with the CD Howe's SME task force and looking for opportunities where we can help provide some leverage and credit to the small business and medium business environment here in Canada, which frankly is when you just go by corporate size is by far the largest part of the Canadian economy. And then the last is illegal export of stolen vehicles. I don't think I'm telling anybody anything new. It's been getting a lot of media attention. In some parts of the GA, we've seen numbers approaching almost 200% in increase in stolen vehicles. There's been problems both in terms of policing, focusing on other areas and taking their eye off the ball from stolen vehicles. We did some intense lobbying here in Ontario, and there was a recent announcement where I think it was something in the order of between $50 and $60 million to create a new auto theft unit. And in Ottawa, we're looking to see the Canadian Border Services similarly to start to take the issue a little bit more seriously. And to that end, we've been working on and we'll be publishing later this week a white paper on the subject. For the members themselves, we see a shift towards solution-based financing or usage-based financing. So some locally would call it power by the hour. So, moving away just from, the numbers in terms of sort of, okay, well, what's the interest rate on this? And as I said, a more solution-based approach to that kind of financing, something that our industry is particularly good at doing. Sustainable initiatives, again, there's an opportunity there, both in terms of working with the government, but also with the industry being particularly and uniquely situated to provide some solutions. And I think last but not least, no surprise, given that Peter Drucker famously said, culture eats strategy for breakfast and investment in people. The CFLA and the industry continues to look to what we can do to attract talent to our industry. It's one of those ones, people don't wake up, go to university and say, I've always wanted to be in asset-based lending. But we find once they're in the industry, it's hard to leave. They tend to enjoy it, and it's something that we're trying to work on both for the industry and in conjunction with government as well.
That's fantastic. Thank you for that. And Jeff, how is Equifax responding to the changing environment?
Yeah, so that's an interesting question. Again, the pandemic really demanded change of all of us here on the line, as well as Equifax as an organization as well. It really kind of forced us to be able to think about what is needed and essentially being agile. Things like when the pandemic started, looking at things like deferrals, how suppliers, the government, basically had wanted to be able to provide deferrals out for loans for any organization, any individual as well. We need to make sure that we were modern enough to be able to go through and build with organizations to handle those deferrals that didn't impact credit policies at all, again, both on the consumer and the commercial side. I think that was really the kind of a key kicking off point for us as well, to help us really transform for us to become a digitally first company. So since the pandemic started, we've really been putting a focus in on moving our core into the cloud as well. And really just making sure that we can be agile enough to create bespoke solutions and be able to kind of go with the flow of what we're seeing in the economy, that a credit report isn't just a credit report, that sometimes there's data, there's insights, there's use cases that come up that really need to be solved as we came through. We were able to work at a city level, province level, and luckily enough with the federal government as the pandemic was unfolding. And the use cases that came up were absolutely interesting. You would go in with a preconceived notion about what was actually going on, and we dive into the data and realize that there's specific industries or specific pockets of individuals or businesses that really needed help. And so by modernizing how we deliver data, how we store data, and how we work with our customers, that's really been kind of at the forefront of where we're at. And it's a constant evolution, but at the same time, it allows us to be more agile and deliver exactly what the industry needs as well. I will say it also helped strengthen an acquisition that we recently made earlier this year. So we acquired an organization called Profile Credit back in February 2023. And Profile Credit, for those of you who don't know, are in the food credit industry. Basically a niche player that monitors the credit health of things like raw ingredients, the supply and transportation of food. And really, again, during the pandemic, we saw that that was absolutely critical. Like understanding how the transportation of food, rather than going to restaurants, had to be cycled into primarily grocery stores, and that the volumes of what we're able to consume on a daily, weekly basis is absolutely critical. That in itself, the food industry has very demanding credit terms. We've heard this from some of the players that have joined us from webinars in the past, that things like perishable goods, you can't have a 30-day credit term on, a box of watermelons. Basically, you need to have it on net 7. It needs to be consumed within a short period of time, and so you have to be very aggressive. And with that as well, it's challenged us, and it's helped us understand exactly where and how credit is managed and how it is kind of set within Canada. So that was really a catalyst for us here on the commercial small business side, is understanding where data resides, how it can be solutioned, and making sure that we have the infrastructure to be able to grow as the economy grows. But again, a pandemic demanded change, and I think in terms of where we stand from a product and insights and core infrastructure perspective, that we're well set here for 2020.
Great, thank you very much. Okay, so I think with that, we have about 9 minutes left. We have some time for some questions from the audience. So what I'll do is I'll take a look. This question might actually be better for Jeff. So we have a question. Do we see signs of credit tightening up from the big 5 banks? Is there an impact from Bank of Canada interest rate increases? And I think we definitely saw some of those indicators in the data that we just looked at. So Jeff, do you have any thoughts on that front?
Yes, so we definitely see a tightening from the big banks across Canada right now, and part of it was, a bit of an interesting story as well. As I alluded to, the fintech community within Canada wasn't part of the distribution of federal loans, so they ended up essentially getting really close to their customers and understanding kind of by industry, by challenge what was going on. The larger banks essentially didn't have that same the same digging into their portfolio, their customer base. So really, what we're seeing now is a tightening of these portfolios as they're learning about how the pandemic impacted them. The pandemic funding really came in, and again, we saw it in terms of our data. Paid down things like credit card balances. So as these interest rates increased, it has a direct correlation to spending. So those lines of credits are shortening down, more funds are going out to credit cards. And part of that is because banks are being very tight with terms, as well as the amounts that they're able to issue out. So on the equipment leasing finance side, we are seeing ticket sizes go up, but really what's going to end up happening is a tightening of the overall amount that the banks are issuing right now, as well as just being overly cautious. So just like we're seeing in the US, they hit it a bit earlier than us here in Canada, but the interest rates are direct impact to the major banks across Canada right now. Each is going to have its own policy and its own portfolio based on the geographies that they primarily reside in and the industries that they're known for. But I'd say across the board, there is a tightening happening with the banks, albeit, again, by geography and by industry.
Great, thank you. And perhaps, maybe Michael, you could speak to maybe the opportunity to access credit through ILCs. Could you maybe give us your thoughts on that?
Yeah, sure. It's interesting. We do tend to see that in periods of rising rates, the non-bank finance companies, or independent leasing companies, as we call them, tend to do well. It's partly, I think, in conjunction with what Jeff was saying, the proximity to the customer. We do a what we call an end user survey. This is where we survey the customers of our member finance companies. And as I said at the outset, I'm not an economist or a banker, and it was surprising to me when I first started to review that data. I was expecting it, when the customers are looking at a financial partner, that rates would be the top of the list. But in fact, it was the relationship with the financing company that topped the list. And in times of financial stress, I think that may be one of the drivers of that. Additionally, when financing or leasing a capital asset, there's an inherent advantage over a basic term loan in that the payments can be structured in such a way, if it's a seasonal business, that you can weight the payments to the times when the businesses are making money and decrease the payments to the times when they're not. And so this is, an advantage of the industry. And then finally, because the asset is, forms, you can retain the asset if they need it and tie the lending to it. The rates could be a little bit better than you might get in a term loan as well. So there is some opportunity there, and it's why we see those sort of non-bank finance companies do particularly well in the SME space during times of credit stress.
Great, thank you very much. We have another question here. Frederick asks, and I'm not sure which of you gentlemen want to handle this one, but do you have any insights on what's helping businesses get through what he calls a hostile credit environment, given that we're not seeing sharp increases in delinquencies? So what's helping businesses get through the current credit environment?
I'll take a stab at that one too, and then Michael, if there's anything you want to add in.
Okay.
Really what's helping them right now is, again, a bit of resiliency that's happened through the economy. If you can't get the terms that you're looking for, I think one thing that a lot of small businesses have really seen is that when there was a request for deferrals across businesses, I mean, it was more on the consumer side than it was in small business, but the fact that it is a conversation, that it's not just this black and white, there is a gray area for small business to understand exactly how much product they're looking to purchase, how much service they're looking to purchase, and that while you might have the appetite to go and receive $20,000 or $30,000 worth of credit, that there's a way to be able to meet in the middle, and whether that's an adjustment on the overall ticket size or it's a relaxation on the terms of 15 days. What's really helped small businesses is that credit managers across Canada know that this is a conversation, right? So it's not just a yes or no on a credit application, it's opening up a conversation. So I will say that it is an unfortunate thing that small businesses are going through a bit of a struggle or a tenuous time in terms of receiving credit, because at the same time, if they're not spending money, they're not making money. So as we say no to credit applications, this is another small business that can't grow or is not given the opportunity to grow. So just being able to double check and have those conversations, what we learned here over the last couple of years, small businesses have found more ways to be resilient. So going through hard times that they've gone through over the past couple of years, if we're going through another one, it's just going to kind of strengthen their resolve to find opportunities through credit departments and credit products.
Great, thank you. Okay, we have 2 minutes left, and we have a quick question here with respect to, okay, so looking for some insights. Catherine's asking for some insights on the delinquency rise that we noticed in the insurance real estate industry. Specifically, is this related to commercial real estate? Jeff, you touched on commercial real estate in Calgary. Do you have any further insights? I don't know that we can get to that granular in our data, but it would certainly suggest that it's yeah, I would assume it is part of the commercial real estate sector. Do you have any extra thoughts that you want to add to that, Jeff? Or Mike?
No, I mean, I echo your point. It's something that Catherine, we can respond to you with maybe a bit more detail, but I think the two are definitely as well. So there's both challenges and opportunities specifically around the Calgary market as well. So if there's specific industries or specific provinces that you wanted to look at, please feel free to send that through in chat, and I can follow up with you directly.
Okay, great. Well, that brings us, I think, to time. So, gentlemen, thank you very much, both of you, for joining me today. And Michael, a special thank you to you for taking time out of your busy schedule to share these insights with us all today. I know that I truly appreciate it, as I'm sure our audience does too. Thank you all again for joining me this quarter. I hope you found the discussions insightful and that you leave with new learnings that you can apply to your businesses. And if you'd like to share this session with a friend or a colleague that might have missed it, a link to the recording will be sent out in the next 24 hours. Thank you again to my production team, and have a wonderful rest of your day, everyone, and we'll see you again next time.
Thank you.
Thank you. Bye.